Hi everybody, today I'm going to share with you a REITs that have IPO 8 years ago and the asset have grown from 4.3 billion to almost 100%, about 8.6 billion. And one thing very unique about these REITs is over the past 8 years, even the asset have grown from 2 properties to 13 properties. These REITs have not done any equity fundraising to preferential offer or right issues before. Okay, so what is this REITs? This REITs is called Mapletree North Asia Commercial Trust. Okay, I think this name a lot of people may be a bit familiar with. Okay, for Mapletree North Asia Commercial Trust, the former name was called Mapletree Greater China Commercial Trust. Okay, it was the youngest REITs among all the 4 Mapletree REITs, and it is a REIT that focus on North Asia. Okay, it is listed in 7 March 2013 with only 2 properties, and one is called the Festival Walk in Hong Kong, plus another Gateway Plaza in Beijing. So with an asset of 4.3 billion. So over the year, the DPU have slowly improved, and at 2016 it started to acquire Sun Hill Plaza in Shanghai, and that's how they grow. And back then in 2018, I think the REITs manager have foresee something in future that we may not be able to see, and they start to change the mandate of these REITs from Greater China Commercial Trust to North Asia Commercial Trust, and that's where they start to expand to acquire property in Japan. And this is in line with the REITs growing, progressing forward. Okay, one thing to know, these REITs have an anchor property called Festival Walk, and this property contribute more than 60%, okay, to the REITs overall income, and this resulted in the dividend income slowly increase over time. Okay, and because of this thing that propel the REITs forward, indirectly you also show one thing called concentration risk. Okay, and what happened in 2019, I think most people is aware of the Hong Kong protests. Okay, and the protesters went inside the Festival Walk shopping mall and set fire on the Christmas tree and damaged the property building. Okay, this has greatly damaged the REITs, okay, and caused the share price to plunge, and of course indirectly affect the performance of the REITs on the DPU. Although the damages can be claimed by insurance proceed, but the damage is done. And the REITs manager actually, I think before that, already start to diversify off the weightage of Festival Walk, but I think it's not fast enough. And thus at 2020, okay, that period they start to acquire summer property in Tokyo. The way they acquire the extra property in Japan is a bit unique. They use a whitewash resolution where they issue more units, okay, to the sponsor, and that's a way, of course, plus that financing. Okay, this is to further grow the risk and to mitigate the risk, and also to mitigate the damage done by the Festival Walk, which actually affect the income of the REITs. Okay, so it is done with the heart, with the intention to help the REITs to grow over the long term. Okay, and now we have been 2 years since the protest is over and the Festival Walk has started to reopen, but another event coming is the COVID-19, which indirectly hurt the REITs further also. Okay, so it's one event after another. However, this doesn't prevent the REITs from continuing to grow. This doesn't affect the REITs from continue to strike way to add value to investor and to grow. And thus at this year they also start to announce that they're going to buy another additional property in Japan also. Okay, and also it's true, but however, one thing to take note that the gearing of these REITs over the past year have been creeping up, okay, to about 41%. Okay, to about 41%. So when the REITs want to acquire property, there's way they need to raise fund. Okay, they need to raise fund, and how they do it in this way that they didn't also go for equity fundraising. Okay, they go for issue of perpetual securities. Okay, one thing about perpetual security is considered quasi equity, So by issuing a perpetual security, it doesn't affect the gearing of the REITs. Okay, and it also did not ask unit holder to come with extra money to subscribe for more units. Okay, so that is one of the way a REITs raise fund to buy property without affecting the gearing, and also without calling for right issues of placements, preferential offer to get unit holder to come with more money to that. And this will further increase the REITs portfolio, and also further you can see that it can reduce the weightage contribution by festival walk from 47% to 44%. Remember, festival walk initially contribute more than 60% during the initial phase, and it start to being divest lesser and lesser, now to about 44%. Okay, but it's still pretty significant impact on that. But for them to really bring down the contribution of every REITs to a low percentage, it really need quite a while. It really might need to buy a lot more properties to go. Okay, so to this acquisition, it further improve the REITs DPU performance. Okay, but one thing to note that because of this, the gearing have went down a bit from 41.5 to 41.9%. Okay, it's very close to the REITs manager threshold of between 42 to 43%. Okay, so that is the REITs manager threshold. So definitely they will continue to acquire properties, okay, to further grow the REITs. Okay, and the main concern is going forward, when they acquire next property, would there become equity fundraising? Okay, so that's something that we are not sure. Okay, we will need to observe on that. But let's look at the DPU over the year. So it started with only 5.944 cents, and it went all the way to the peak of 7.69, okay, cent DPU at FY 1819. But after that, the festival walk, the protests come, okay, and the DPU have dropped. And this year the DPU have further dropped because coupled with COVID-19. We know that when it comes to COVID, shopping mall are told to shut and they need to give rental rebate. Okay, plus the festival walk also have been recovering from the Hong Kong protest, and plus some of the property, plus the property in China are not doing that well, and thus the DPU further drop. Okay, so if you look at the chart of these REITs, you can see that it is not a very smooth flow for the REIT since IPO. Yeah, go up and go down, but you can see that actually in general it's on an uptrend until $1.48, and from there it start to plunge because of the protest. After the protest is over, next one is come COVID-19. So the REIT has dropped from a high of $1.48 to 63 cents. Okay, that is a more than 50% drop in the REIT price. Okay, over this period. However, you can see that it has slowly start to recover to 107, around 107 currently. Okay, and this is why when you want to invest in the REITs, one thing you need to look at it is, okay, certain external environment is beyond their control, like the Hong Kong protests, the COVID-19. But another thing you want to look at is the sponsor willingness to help the REITs, and the sponsor resources to able to get more properties for the REITs. Okay, in this REITs, we can see that how willing the sponsors are going to help the REITs to divest out, and they even come up with whitewash solution to even issue more units. Just the sponsor just come up with more money to help the REITs to tide over during this period. Okay, so this is one thing that I like about the REITs, is they got a very strong backing and alignment of interest by the sponsor on them also. Okay, another thing I like about this REIT is called the compensation structure. Okay, we all know that REIT manager need to be compensated. Okay, because they have to manage the property and grow the property, they need to be paid to do that. Okay, so most of the REIT compensation structure is paid by, there's something called a basic, and there's also come a basic fees, and also there now come with the performance fees. Okay, so the basic fee is usually a percentage of the asset. Okay, whether it's a good asset, no good asset, as long as the asset got value, they take a percentage of it. The next one usually based on the growth of sometimes they based on net investment income growth, then they take a percentage of the investment income. But this REIT is very unique. Okay, in that aspect, because based on asset, they may not really have a full alignment of interest. This REIT is one of the REITs that have a very strong alignment of interest between the REIT manager and the unit holder based on the compensation structure. Is it okay? It is the first Singapore REITs that do not base on AUM fee structure. So what does that mean? Do not based on AUM fee structure means that regardless of how big the REIT is, the risk manager are not being compensated by the how big the property is or the AUM is. They are being compensated by a percentage of the distributed income. Okay, for example, you look at this REIT, the base fee is based on 10% of distributed income. Okay, what does that mean? Because distributed income is the income they were able to distribute to unit holder as a dividends. Okay, as a dividend. So the more distributed income they have, the more dividend you collect. So it's based on the percentage of that. So that means that if they have more income to be distributed, of course they will have a higher basic salary. If they have less income to be distributed, they will have a less base fee. Okay, so this is more alignment of interest with the unit holder, because as a unit holder you will definitely prefer to have more income to be distributed to you, right? Okay, so this is what we call alignment of interest. That's the first part. The second part is the performance fees. Okay, the performance fee is based on 25% of the differences in DPU in the financial year with the DPU in the preceding financial year. Okay, multiplied by the weighted average, okay, of the number of units issued in the such financial year. Okay, so if there's no increase in DPU, what happens if the DPU drop? Then there's no performance fees paid to the risk manager. This is a bit different from some of the other REITs where they're just based on net property income. Okay, so this is a key differences that you can see that we call alignment of interest. And because of the Hong Kong protest and the COVID-19, the REITs DPU have been dropping for the past 2 years, and thus the risk manager will not be getting any performance fees on that. Okay, so they call it, they waive off the performance fee. So they will only start to receive performance fees when the DPU exceeds 7.124 cents. Okay, which is the DPU you collected in FY 1920. Okay, so the DPU need to exceed that amount first, then they'll talk about performance fees. Okay, so this is what I like about this REIT. Plus, they got a very committed sponsor that will always send in to help the REITs when there's a crisis happen. Okay, however, this is just two key elements. Ultimately, the properties is still play a part. If the property is a lousy property, it don't grow, in the end you still go back to the same thing. Okay, so this is how much I share about this REIT. And the other concern, as I mentioned, is more of the gearing aspect. So if you are holding these REITs, okay, as I mentioned, these REITs have not been issued any preferential offer or right issues in the past 8 years, and it managed to grow the asset to 100%, close to 100%. So going forward, if they were going to continue to grow, they can't do debt financing and issue perpetual securities forever. So there will be a point of time a preferential offer or right issue may come. So if you are holding this REIT, so you need to be mentally prepared for such a thing to come in the future, but we don't know when will it happen. Okay, that's all I have to share today. If you have benefit from this video, do like and share this video, and do remember to subscribe and press the notification button so that you'll be notified on the next video. Thank you for watching this video, and I shall see you soon. Bye bye.